wildly more popular before Facebook came. So Facebook came and turned it. So think about this for a moment. Let's just talk about human psychology. Think about malls. You have these malls, and there's this mall called Ansel Plaza, which was a very popular mall which came into existence some 15-20 years ago in Delhi. It was a place where people hung out all the time. Youngsters would go there, families would go there. It was a cool place to go. But then Gurgaon came up, and then Vasant malls came up, and then Saket malls came up, and people moved. So the thing about platforms, there's a lot of social proof out there. People go there because people go there, but um, people can change, and crowd behavior is hard to predict. While at the time when you're studying a platform company which is very dominant, it seems at the time, of course, that nobody's going to shift. Think about BlackBerry, the phone that had very sticky customers because people were hooked on to BBM. And if you're on the BBM platform, BlackBerry Messenger, those of you who are new may not even know the term. It was a very, very powerful platform because you could message anybody else on a BlackBerry. It was very secure. Almost everybody had Blackberries, and you had BBM. Now you have iMessage, you have WhatsApp, which can go across very technological platform. They can work on Android phones, they can work on Apple phones, they can work on any phone. But BBM would work only on BlackBerry phones. So people would buy BlackBerry phones because they had to be on BBM because all their friends are on BBM, and therefore they want to be on BBM. Think about this for a moment. Go and study what happened to BlackBerry. It was abandoned in just a matter of 2 or 3 years by users around the world because a better technology came. So the world of history in platform businesses is full of examples where platforms that appear to be dominant and extraordinarily profitable were subsequently destroyed by something else that came. And it's very difficult to visualize what will come that will destroy uh, Google or Facebook. I can't visualize that right now, but this is exactly the problem here, right? It was very difficult to visualize that what would destroy the franchise of the dominant newspapers. It was very difficult to visualize what will destroy the dominance of BlackBerry. So at the time when those businesses are doing extraordinarily well, it's very hard to visualize or predict that they will go, but they almost always do. So that's the case. The Ansel Plaza Mall is a dead mall now. Nobody goes there because nobody goes there. The reason why people would want to go to a mall because all your friends are going there, all the restaurants are over there, all the stores are over there, all the happening events are happening over there. But when people don't go there, then people don't go there, right? So crowd shift, crowd mentality is a study, is a subject worth studying anyways, and that's part of social psychology. And you should read books like The Crowd or Extraordinary Delusions, and there are a whole bunch of books out there. But the point is that a lot of success of platform businesses is because of crowd behavior, and crowd behavior is very difficult to predict. It can change suddenly, and when it does, then what appears to be very profitable today may turn out to be not so profitable just a few years on the road.
That's a very interesting point, specifically in relation to the crowd shifting to a place or a platform. So, I think, don't you think these businesses, these dominant platforms also realize this risk? And if you look at, see, these companies like Facebook, or so just take Facebook's example. So Facebook had also bought in WhatsApp, also acquired Instagram. If you look at Amazon, you can see that they also started their streaming business. In case of Google, they also have YouTube now. So don't you think in these cases, probably, or what is your view? The dominant platform is so conscious about all these risks. They are deepening their moats even more by acquiring other platforms.
Okay, tell me what is happening with Netflix. Netflix started losing users, right? And they
Right.
had the highest budgets. They had the streaming services around the world. They had a subscription
Right.
model, and it was some everybody. You can't afford not to have Netflix. Everybody was subscribing to Netflix. You wanted to be there, right? And now they're losing users. So I'm not so sure. Again, the point is, um, 2 years ago, could people have thought that Netflix will have this problem what they're having right now? No. So it's very difficult for me to say how people will abandon Amazon or what will happen. Even the founder of Amazon is conscious about the risk that Amazon will die one day. Um, so while these people are very, very grounded in reality, they follow the founder of Intel's book, Only the Paranoid Survive. They're very paranoid. They know that they are in a space which is changing very rapidly. The landscape changes very rapidly. People's preferences changes very rapidly. And these are very large companies. They become, there is this concept of scale economics, but as Charlie Munger once mentioned, there is the opposite a model of diseconomies of scale. So you become very large, gigantic companies. You tend to become bureaucratic. You have layers and layers of costs which new, nimble upstarts don't have. And those are the guys who will destroy you. And these guys know that, and therefore they're paranoid about it. And therefore they go and acquire an Instagram or a WhatsApp, and though they turn out to be fabulous decisions, but then you have to keep doing the right thing over and over again. It's like, you have to stay lucky all the time. You get unlucky once and you're done. And this is the point. The odds are against it. I'm not saying don't own those businesses, don't invest in them. I'm just talking about odds. That the landscape changes. Uh, it's very hard for me to predict that the phone that I have right now, which is an Apple, I think 11 or 12, will be the dominant phone 10 years from now. While at this time, of course, everybody says there's no way Apple can be dislodged. But if you go back in history and study BlackBerry's, story, you will say exactly the same. What the confidence that people have in Apple is exactly the in terms of the dominance of the smartphone businesses globally, is exactly the degree of confidence they had with BlackBerry. So people do turn out to be wrong about their judgments about how future events will play out.
That was fascinating, sir. And specifically in case of Netflix, probably since they were a focused business only on streaming, that risk is probably much higher than in terms of risk when you compare to something like an Amazon or a, because they have diversified into other areas as well.
Yeah, I mean, the thing is that Blockbuster was destroyed by Netflix. Prime may destroy Netflix. Who knows? This is the way it is. A life of businesses is full of ups and downs. There will be periods and trajectories where you will have, going up and up and up, and then you will decline. And you will decline for reasons that are unknown to people right now and will be known much after it has happened, actually. So look at what happened to Kodak, right? And when Kodak was the company which actually, I think, invented the digital photography, but they never popularized it. uh, Again, the point I'm making is that disruption is here and it's not going away. Being big and rich is not a certain way of ensuring that you don't get disrupted. It may delay it for sure. It may even stop it if you're very smart and stay lucky. But will it be 100% surety that if you have a strong balance sheet, deep pockets, huge number of talent, that you can't be disrupted by some guy in a garage, in some remote part of the world? I'm not so sure about that.
Right, right. So moving on, sir. So I'm currently reading this book called The Payoff. It is also a very good read on how the payment landscape is changing all over the world. And the book was published actually in 2021. And something interesting is mentioned in the book there. So I'll just quote from the book. Facebook is worth a little less than, and Amazon just a bit more than, the sum of the six largest banks in the entire world. Of course, after the recent corrections, the statement may not hold true today. But from the Indian stock market perspective, how do you find the banking and finance space vis-a-vis the technological space in the long run? I have read about your dislike for lending institutions in general, barring a few differentiated models which are not very risky. However, would you say that the banking sector in particular may not see the valuation it saw in the last decade due to the emergence of fintech and other technology businesses in India?
See, Ankit, you're asking me to comment about what the market may or may not do in the future, and I have no way of knowing that. So it's not something which I will venture out to make a prediction on. Um, um, the thing about technology is, see, when you look at technology, it's an opportunity, it's a threat. It's a threat for those who don't use it as an opportunity because somebody else will. And it can be a huge way of enhancing the bond with the customer and growing your more. I think the best fintechs are actually inside banks. There are banks which are modernizing, there are banks which have teams, and there are banks which are doing a lot of things. A lot of these so-called fintechs that you talk about, and it's not just my original idea. I like the idea. I read about it recently. They are just relabeled or glorified DSAs, direct selling agents of these banks. They have affiliate relationship with banks. So we call them fintechs, and they're all loss making. They all are raising money from investors that world has changed the last few months in 2022, and therefore they need money to burn. And fintech is just one class of those businesses, and there are so many others which have similar characteristics. um, but the point is that banking as an industry is not going anywhere. I think banks are the ultimate platform business, and they're going to be around. They serve a very basic need of society, and that's going to be around for a very long time. Whether technology can disrupt banking, the answer is yes. And of course, within banking, there are banks which are investing heavily in technology and intelligently in technology, and which is enhancing their edge over competitors. And there are other banks who are not doing that. And of course, the ones which are not doing it will lose in the long run. So within the banking space, there will be churn, no doubt about it. And within fintech space also, there are these new kinds of business models that have come which don't make any money but are trying to disrupt the banking space. I think in order to fight an enemy, you need a lot of ammunition and you need a lot of strategy. You may have the strategy, but you don't have the ammunition because the ammunition is not yours. It's coming from your investors. And if they stop giving you the ammunition, then your ability to fight sort of goes away. So again, I go back to my original idea that I don't like businesses which consume cash in the long run, and which will keep consuming cash for the longest time, because there will come a time where the access to the cash will stop even momentarily. It's like oxygen. If you don't breathe for 60 seconds or 80 seconds or 2 minutes, you just going to die, right? So if the oxygen supply is withdrawn for whatever reason, even momentarily, then their ability to disrupt the banking industry will evaporate. And that actually may be happening as we speak. So I do feel that the best technological disruption will be done by banks themselves. Of course, there is massive technological changes that are happening in the payment space, and that's going to be a game changer. And India is sort of leapfrogging into the world's best payment space technology that I'm aware of. And that is going to be extremely disruptive, and it's going to be hugely opportunistic for some businesses out there, no doubt about that.
Thank you, sir. So moving on to the next question, and as you rightly said in the answer to the last question, that you don't like making any macro forecast or prediction. However, macro factors do affect businesses. So in this kind of environment where there is a consensus feeling that inflation is there, so are you thinking differently about your investments, or everything is as usual as it was in the last 10 years for you?
See, again, I go back to history. I've been doing this for 27 years, and I've lived through a period where inflation was 15% and interest rates was 17 or 18. Fixed deposits in banks was 17 or 18%. I lived through that period. Now, um, I think it was late 90s, um, early 90s, or mid 90s, sorry. Um, if you look at wealth creation in India in equities since that period till now, it has not been hampered because of inflation. Uh, so inflation, of course, is an enemy of. It's like a tax, right? Buffett has written about it. It's a permanent tax. It's a compulsory tax that everybody has to pay, and there are ways of thinking about it. But the key point to recognize here is that inflation, high inflation, unless it becomes hyperinflation, does not prevent wealth creation to occur. That's one. Number two, what are the choices that investors have? They can invest in fixed income, which are fixed claims, which are going to get completely destroyed because of inflation, or you invest in a variable claim security, which is what equity is, that there is at least a chance of earnings growing faster than inflation and value being created because of that over time, and therefore at least there's a chance for you to beat inflation. And the only asset class in my judgment that meets that criteria is a business that makes money. And there are some businesses that are going to get hurt by inflation. There are some businesses which are going to get less hurt by inflation. And as a consequence of living in a pari-mutual system, if you are hurt but your competitors are hurt much more than you may actually come out ahead. That's the way the game actually should be understood. So inflation, there are many ways of thinking about inflation. I think one, of course, is the impact of inflation on economic earnings. So there are these capital intensive businesses which have a lot of fixed assets, and these fixed assets need to be replaced. And the replacement cost, because of inflation, tends to grow up quite a bit over a period of time. But you are providing depreciation on original cost. By the time the asset needs to be replaced, there is no money in the firm left because of accounting of a depreciation did not allow you to conserve as much capital as would be required to replace the asset. So your economic earnings are sort of overstated. And that's a technical topic. I don't want to delve into that, but basically, inflation will hurt businesses that employ a lot of fixed assets, which tend to depreciate rather quickly and need to be replaced, and the replacement cost, it tends to be higher over time. So that's one thing. But think about this for a moment. If you are invested in a commercial building which has got these tenants, and the tenant and the rents are going up because there is inflation, and the building tends to appreciate over time because it's a well-kept building, it is in a good location, and land values tend to grow over time. Then in this kind of a business, the inflation is actually good for you, right? Because you don't have to replace this building for the next 100 years. It's got a life of 100 years. So the depreciation that you provide on the asset is actually fictitious depreciation, because in the books you're bringing down the value of the building. In real life, the value of the building is going to grow more than the rate of inflation, because the rents are growing at more than the rate of inflation. So it depends on the business. You have to be very careful to distinguish between what is this business, how it's going to get hurt. uh, if you think about working capital, also not just fixed capital, inflation has a role here. And this is a point that Buffett made in one of his essays, which is not, I think, fully understood by a lot of analysts. Because I want to, highlight this point as to what happens to working capital intensity when inflation occurs. So imagine that you are using 100 units of raw material, uh, and uh, and the price of the raw material goes up. You still need 100 units of raw material to make whatever widgets you make, but now you have to pay a higher price for that. So raw material in terms of units is exactly the same, but raw material in terms of INR will be higher because the cost has gone up. So in terms of the balance sheet line item, your inventory will go up simply because of inflation, even though the amount of inventory in kgs or units or liters or whatever it is exactly the same. Because the price has gone up, your inventory on in INR terms has gone up. That inventory will eventually become finished product and will get sold to a customer to whom you are lending money. You are still to whom you are giving credit. That customer is still buying those 100 units or whatever 50 units of finished product that you're making, as he was doing earlier. But now because you are charging him a higher price because of inflation and because he has been given credit by you, receivables will go up. So the same number of units that have been sold, there's no physical volume growth in the business, but your inventories have gone up and your receivables have gone up. So therefore, your working capital requirement has gone up. In rupee terms, you need more working capital. Business is asking for more working capital simply because of inflation, and it has happened not because the business is growing. Business has not grown. The units that you are selling are exactly the same, but the nominal value of raw material and receivables has gone up, and therefore working capital requirement has gone up. And therefore, if you don't have the money in the bank, then you have to borrow that money, and there's an interest cost, and all that will happen. There's an impact on the P&L, and there's an impact on ROCE because the capital requirements have gone up, and therefore all that has to be thought through carefully on a business to business basis, because businesses that are raw material intensive, inventory intensive, and receivable intensive will also get impacted by inflation. Um, then of course the impact of inflation is on interest rates. Typically high inflation means higher interest rates, and higher interest rate means higher discount rates in DCF, and higher discount rates, other things remaining the same, means lower value. But this is misunderstood because other things are not the same, because inflation does tend to drive up the prices of products. Is the cause, which is inflation is the effect. The cause of inflation is rising prices, and rising prices means people have to pay more for things, and if they have to pay more for things, then revenues of the nominal revenues of those companies are going up, and nominal earnings of those companies are going up. Some will go more than inflation, some will go exactly in line with inflation, some will grow with less than inflation, some even decline. So you have to think carefully about what will be the impact of inflation on this particular company. You can't just say, well, other things are the same. Interest rates have gone up, therefore in DCF the value will come down. That's not the case. By the way, that is exactly the case with bonds, because in bonds the money that you will be given by the bond issuer will not change in nominal terms. It's exactly the same. They will give you exactly the same amount of interest and exactly the same amount of retention money 5 years out or 10 years out. And if you have to bring that future cash flows to present value at a higher discount rate than before, which is what higher interest rates would require you to do, that means lower bond prices. So therefore, inflation is a terrible, terrible enemy for bond investors, but not necessarily for stock investors. Then, of course, is the idea of pricing power. There are some businesses which have the ability to increase prices. At least some pain can be passed on to customers without fear of loss of unit volume and market share. And we've seen that. We see a lot of those businesses out there which are basically selling products which are of basic necessity. But that doesn't mean the pain is not there. And look at FMCG companies right now. They're all hurting, right? They're all going through a period of shrinkflation when they are reducing the price of their product, the size of their packaging of the products, just to sort of effectively increase the price on a per unit basis. So they try. There are businesses that will try and succeed. There are some businesses that will try and fail, and there are some businesses that can't even try because they don't have pricing power. So obviously, on a spectrum, businesses which have pricing power will tend to either benefit or get hurt less. Again, I bring back the principle of pari mutual investing. If you think about it, all businesses in the end are fighting for scarce capital, right? So an FMCG company is fighting for capital, against a company which is in the hotel business and so on. The point is, if you look at it from that dimension, then there are some businesses which inflation will benefit, and some which will be hurt by inflation. And of course, then there are these asset businesses, businesses which are sitting on assets which will go up just because of inflation. Prime land is a case in point. We don't have those companies in India, but timber was a case in point. If you're sitting on valuable inventory of something that is scarce, which tends to grow in value over time in nominal terms, and that will protect your business from the ravages of inflation. So there are all these ideas about inflation that come to mind, and I remember Shakespeare's quote here that there is nothing good or bad, but thinking makes it so. You have to go deeply into the idea and then think about